Great. Welcome everybody to this session. So we thought instead of talking about how to make a pitch deck or how to get investors to invest in you, we're actually going to learn on how to build a VC fund. So for those of you in the room that want to do it, this could be very interesting. For those of you that are startups, it could be interesting to understand the mechanics. For those of you from the industry, and maybe it could be interesting to understand like what the troubles and the easy things that is going on. So that we can maybe have a bit of a raise of hands. Who of you has a startup? Okay, great. And who of you is working in a VC? Good. And who of you is a facilitator? Okay. So great. Then we can a bit understand who's here. So my name is Isabel Seacrest, and I'm also an active investor, and I have two great panelists with me today. So Gina has been building Emerald for the past, how many years, Gina?
25.
25 years. She is really like one of the pioneers of VC in Switzerland, and she can talk a lot about her experience about building Emerald to her full-fledged size. And Andrea Buhofer, still Buhofer. Okay, Andrea Buhofer is a partner at Equity Pictures. It's a newer fund that you established in the past few years that you're working with, and I would be also looking forward to have your experience sharing. So let's get started. So, Gina, how did you decide to start Emerald 25 years ago? What brought you to the VC world, and what's maybe your personal journey into it?
Yeah, sure. So I started, in the 90s, I worked at Sulzer. I was the head of strategy and M&A. It was a time when Sulzer went through a massive restructuring. I'm sure a lot of people don't remember that. It was a company at the beginning, horribly diversified, over 60 different units. And together with my team, we bought, sold, IPO'd dozens and dozens of companies. And when I left, we had 3 divisions. And after that, it's not that much fun to be the head of M&A when the big restructuring is done, and I didn't want to go into operations. So I kind of reflected a little bit, when we were doing the kind of reorientation of the corporation, we had certain hypotheses, and one of the very strong hypotheses we had, although it was probably a little bit too early to have that hypothesis, was that sustainability trends are going to have a massive impact on industrial sectors, both creating challenges and opportunities, and that technology innovation is going to bring a lot of the solutions. And so then I decided, hey, that would be cool. I can go and let's go find those technology innovations with the startups and then help them work with the corporations so the corporations will manage that transition. So that was kind of the idea behind it. I then joined actually a startup, Sustainable Asset Management, which had just launched the Dow Jones Sustainability Index, and I built up the venture capital business. And when we sold Sustainable Asset Management to Robeco in 2006, we did a management buyout, and then we rebranded to Emerald. So we took the venture business with us and rebranded. So I didn't start completely on my own. Never really had the big ambition to be completely on my own, but it just kind of happened.
Yeah. Well, that's also an interesting journey that you then rebranded. I don't know if a lot of people knew this story, but I think it's an interesting one. So actually also for Andrea, you had a start where there was something already established and you basically joined the 2 partners. So maybe you can talk a bit about your experience entering into VC, entering Equity Pitcher, and building your first flagship fund that's when you entered.
Yeah. So thank you very much for having me here today. So my background is actually from the Swiss production, where I worked for 4 years during my studies. After that, I went to Asia for DKSH, and the head of Asia, his vision was to start a corporate venture capital fund. So that was my very first touch points I had with startups. So coming from the very slow, traditional Swiss production company, and then coming to Asia where everything was happening so quickly, and then working together with startups, I fell in love with this chemistry between the both, so the tradition and the money that the industry has, but then working together with startups who have the innovation and the agility. And so I came back in 2019 and I met Equity Pitcher Herman and Sasha. I started there as an intern, so they were just starting actually their fund, because first they wanted to have a platform where they connect investors and startups. And then they pretty fast they found out we need a fund, because the good startups, they need much faster decision making. And the investors, they didn't want to invest into having the skills themselves. So with family offices, asset managers, and they didn't want to have any asset outflows. So they asked us, hey, please start with a fund, make a bookable product that we can have in our depot, and so we have the exposure in venture capital. And that's how we started as a fund. I then joined Equity Pitcher. The very first fund was a mini fund, probably the most expensive and the most inefficient fund in history. So it was 4 million actually, so very small. You lose relations to money because 4 million is a lot of money, but for a fund it's very small. But it was the feeder fund. It allowed us to show how we are doing our investment strategy, how we select startups, to get actually a track record that all the investors were asking for. And so this was the feeder fund for the second fund, the flagship fund that you mentioned, which was then 50 million. And how I joined Equity Pitcher is that after 6 months of working with Herman and Sasha together, we found that our chemistry is like really, really good. We work in a very good way together. They have been working, the two of them, for 15 years, so it was very difficult to get in. I like that they take me into decision making. But it was good, and I'm now a part of the partnership team, and I raised the second fund together with them. And so, yeah, that's how it went.
Yeah, I think this is from both of you nice journeys to say, you know, your entryway, how do you get into this business and how do you actually raise your own fund? And it seems like both of you kind of boxed your way. You did it with rebranding. You found an existing team and actually joined them, and also basically at Equity Pitcher pitched yourself as well as and proposed as a partner. I think one thing we're not highlight, or you didn't highlight, but I'll highlight to you, Andrea, you really substantially helped raise the capital, which actually brought a real value, I think, also to your colleagues at the time, right?
Mm-hmm. Yeah, so the backgrounds that we have are very diverse. One of the founders, Herman, is an entrepreneur. The other is an investment manager. And I had the network. I had the network with high net worth individuals in Switzerland, and these were the first investors that gave us the trust. And they're both from Germany, so they didn't really have the network here. Mm-hmm. So that's why we decided to go on with the three of us.
Yeah. Very interesting. So Gina, also back a bit to you. You know, you today, maybe you can talk about how many funds you have and how many AOMs you're running. But I also think it's interesting how over the years, you know, you went from this first entity to have now, you know, several funds established and a big team that you're managing. So raising is extremely difficult. So maybe in the early days, what was your strategy and how did you end up where you are today with the size you are?
Sure. Yeah, so we started, 25 years ago, launching a sustainability venture capital fund. So we were first-time team, first-time fund in a sector that did not exist. I didn't know that. when
Ahead of your time.
Exactly. And as I was saying yesterday, you couldn't even Google things because Google didn't exist, right? So there was Ask Jeeves, and I put in there, Ask Jeeves, what is venture capital? And it gave me like 2 academic papers, and that was it, right? So we just kind of started. And so we had a strategy of doing transatlantic, so both North America and in Europe. And we were the first in Europe in that sector, one of the first in North America. And for the very, very few investors out there who were interested in this topic, they kind of had no choice. They had to invest in one of, very few. So we were super lucky, and I wish I had realized how lucky we were, but we raised 100 million euro in our first fund. And I had come from corporate M&A where I was doing hundreds of millions of deals, right? And I was thinking, 100, yeah, okay, we can start with that. Right? Yeah, I should have had a huge party. But that was our first fund, right? And clean tech has gone through, we called sustainability, then clean tech, then climate tech, industrial tech. We basically have been doing the same thing. We just call it different things depending, or the market calls it different things if you'd like. So the sector went through quite a bit of change, and we also, we made lots of mistakes in our first fund. We were too early stage. investment criteria wasn't really baked through and stuff. So I really am incredibly grateful to those people who gave us the first 100 million.
Did you make money off of it in the end?
Yeah, it wasn't too bad. It
Okay,
wasn't too bad.
good on you. I mean, sometimes you can go like
it wasn't a
negative.
great vintage, but it wasn't. It could have been a lot worse. Put
Okay.
it that way. But yeah, so we've changed a lot over the years.
Yeah.
We've refined our investment strategy, our criteria, our internal processes and stuff. So then we raised in 2016. I think I'm right. We raised our fourth fund, and we raised that as a flex term fund. And I should also
What's
say
that?
that all of our investors today are corporations. So after sometimes, what doesn't kill you makes you stronger. So we almost died after the recession of 2008, but we didn't die, but it made us we had to become a lot clearer as far as what our value proposition was. Exactly what we tell our startups, right? What's your value proposition? What's your product market fit? Who's your target market? We're like, oh shit, that actually applies to us too. And so we decided, hey, you know what? We're going to only work with corporates. Because they're the ones who need this innovation. We can deliver a lot more value to them, and they're very sticky. And what we also found is that corporates actually don't like the process of investing in a fund. And they really don't like when you come back after working very closely together for 5 years and say, oh, you know what, you guys have to re-up into the next fund, otherwise we're going to cut you off, right? So we developed a structure called a flex term structure where they can join whatever they want. We've made this structure now public, so whoever is interested can look at it.
Over Google.
Now, you can probably Google it. But it means that they can join whatever they want. They can stay as long as they want, right? So we have now around 60 corporate investors, and over the years, only 2 have ever terminated their investment period. So it's incredibly sticky. And today we manage about 750 million euro.
Yeah. Oh, great. So it's I love the journey that you thought 100 million was small. I knew that. I don't know if Andrea knew that, because I knew that
She's
you started.
much more realistic. She knew what she was getting into.
So, Andrea, for you, the big flagship fund has been the one that you worked on.
Yeah.
So how was it, for those of you that don't know this, but, they have to go out and pitch and get LPs to sign, right? I think, Gina, you said that basically you took everybody's money at the time. Beggars are not choosy.
Exactly.
So how was it for you to raise the first fund and actually close it out? Because I guess that's when we got to know each other, when you were raising it. I remember you were out there.
Yeah.
So.
Yeah. I was networking a lot. That's so true. I was on events from Monday to Friday. And sometimes just because I knew a potential investor was on a panel, and I went to the whole evening was blocked because I went to the event. And when he was done with the panel, I was sneaking in the back and tried to get a meeting. So I was networking a lot. But we have always also been defining or investing a lot of time in defining our investment strategy so that it's for a long term. Because what we didn't want to do is change it all the time and just to be trend followers. So we had to decide on what is it really where we want to place our money. And we decided pretty quickly that we want to invest in Switzerland, and Switzerland does not have any natural resources, so we don't have any oil or gas that we can go back to. So we need to be innovative in order to be competitive on an international level. And corporates, they will invest in innovation, because otherwise, Switzerland will not be able to pass this wealth to next generations. So that was a lot of investment that we did at this time to really shape our investment strategy, to make sure that we know the market. We have built an advisory network with 50 people who were absolute experts in different kinds of fields, because we said we want to invest diversified. So we want.
And that was also instrumental for you. I think that's not everybody does that.
Exactly. So we have those industry experts that we really in the investment process. They support us and to really understand the market, because when we lost money was always when the technology was great, the team was great, but there was no market demand. And so we decided we really want to invest into this advisory network. And then yeah, this is how we have been investing now, also with the third fund, which we have just launched, and really investing into long-term also relationships with our investors. So always being very transparent, making sure that you are always communicating honestly and very, like, you're not faking till you make it, like sometimes in the startup world, right? If you want to be a VC and you want to be here in the long term, you got to be very like down to earth. Because yeah, if you have one fund that is not performing well, then it's going to be very difficult to raise another fund.
And I remember, I mean, that you told me, you split up the team. You kind of told us you were in charge of Wuhan VEs and kind of family offices. What did your colleagues do the rest of the day?
So we separated. So one of us three partners was in the investment process. The other one was in fundraising, and we like split the whole portfolio management between the three of us. We changed this in the beginning of the year because we are now raising our third fund with 100 million that we want to raise, and it takes all of the three of us. So we need to be in fundraising, all the three of us. The investors, they always want to see the whole team. So it's very also like for the first meeting at least, we all have to go there and show us, and because it's a people business at the end. And if you don't have the track record for 25 years, they want to see you and they want to understand how you work, and they trust you, and then they will invest in you also.
Well, maybe I'm citing this wrongly, Andrea, and correct me this, but I remember you said that you actually in the flagship fund you had a pension fund money, and that I thought was like, Andrea, how did you do that? For those of you that don't know how it is to raise with pension funds, they want secure returns, but our asset class is kind of hairy and high risk, and especially Swiss pension funds are not like investing in VC, but the return window fits. Right? Because they can invest long term and we return only after 10 years. So maybe you can talk, how did you get that signed and closed in?
Yeah, that was quite difficult with pension funds, and it took a lot of time until they came. Startups always, when they say, oh, fundraising is so tough, I'm like, you're so lucky you can fundraise with people who actually understand your asset class. And we are fundraising with people who sometimes you have to spell venture capital, right? So they don't understand. Mostly they are at the end of their career, so they're not really willing to take risks or do something they don't understand. Maybe they are also burnt child from the .com phase, so it's very, very difficult to fundraise with pension funds. But I think the timing is, it's going in the right direction. We have now 10 pension funds that have invested into us, and they made very small tickets. So they call it a discovery ticket. So they invest like 3 to 5 million, and they want to understand, okay, how does it work with this asset class? How much work is it for me? Because normally they put in 50 or 100 million, and they place it, and they don't hear from it again for 10 years. And this is different in venture capital because you have capital calls. So it's a lot of work for a pension fund. But they are digging into it. There are also great initiatives, which I talked before about the Deep Tech Nation Switzerland, which wants to raise together with the AWI. They want to raise 700 million that they want to invest into venture capital funds from pension funds. So it's all going into the right direction, I guess.
Yeah. So I think that's always like interesting that in the background who are these LPs as well, right? So family offices, pension funds, but also like there's fund of funds, so other VCs that can invest into this. So when we go into a bit the structuring phase, I always like maybe also for Gina, Emerald has like multiple funds, and you're also like not just managing the fund structure, but you're also managing a team. Now, we didn't talk about this yesterday, but I was also curious to ask you this today. It's like, how do you set up the fund structure? Because you have very international investors. So, we were talking about it before, but depending on your fund structure, it can eat so much administrative costs that you can actually sit on a fund that is, 100 million, even 50 million, and you not make a return. So how do you structure your funds today? And, maybe also in which jurisdictions? That would be interesting maybe for the audience to understand how this works.
So right from the very beginning, we had a lot of international investors, so we had to find a jurisdiction that had tax treaties with all of these different domiciles from our LPs. And back then we picked Guernsey. So for, I would say, about the first 10 years or so, we had all of our funds based in Guernsey, because we do have different sector funds and whatnot. And then we changed actually to Ireland because Spain and France have an issue with Guernsey. So it wasn't any of the other international investors. It was more 2 European countries. Spain actually never ratified the dual taxation treaty, and France still considers Guernsey to be kind of on a grey list, right? So we moved all of our, we started all of our new funds in Ireland. And Ireland is, for us, it's less expensive than Luxembourg, because Luxembourg would also be a good jurisdiction. Switzerland started this fund structure, none of our international investors wanted to even hear about it. Yeah. They were just like, this, too hard pile. If you guys are going to go with Switzerland, we're not investing. So we said, no, we're not doing Switzerland. So we had them all in. We have them all in Ireland. And so maybe also to mention, so we've got funds, right? We've got our flagship fund, which invests across all of the climate tech, from energy, water, industrial IT, mobility, food and ag, and whatnot. And we also have some sector funds for those investors who only want exposure to energy, water, and sustainable packaging. So we've got, say, those 4 funds. And then we also manage the CVCs for 4 corporates. Yeah. So if you'd like, they outsource
corporate VCs.
Yeah, corporate VCs. The corporation basically decided not to hire their own investment professionals. They outsource the entire investment process to us. Their team focuses on achieving the commercial or strategic relationships with those startups, and we do the scouting, assessments, structuring the deals. We lead the deals for them, because obviously corporates typically don't lead deals, and then we sit on the boards and we manage it all the way through to an exit. And their team is really then focused on how to capture strategic value by working together with the startups.
And maybe you can hear it, Gina, but you said it, you normally structure the fund according to your investor base, right? So for anybody of you that wants to start a fund, right, first find the investors and then build the structure and have the right people. And I remember, because, we also have a fund, so I remember this discussion Andrea and I had, and I actually had a talk with the way you structured it. They wouldn't take me because I'm American, so we actually went into the last stage with them, and you're American, so we can't work with you. But maybe you can talk about the structure that you picked for your flagship fund too, and I don't know if you're going to do it again or change it.
So the first one was the Treuhänderschaft.
Okay, yeah.
But this is not relevant. We have to talk about the second fund.
Yeah.
Because
the flagship
no
one.
one really wanted to make a SICA fund with 4 million, right? But when
Well, maybe it could be interesting for the ones that want to start, even if it's a toy fund.
Yeah. No, but it's way too expensive. It doesn't really work. But with the second fund, we were actually the first fund, VC fund in Liechtenstein, and we decided to make it with VP Bank together. And the structure is, we have a SICA fund, which is the umbrella structure, and then you have the funds that you can manage under it. So we have the first fund, the second fund, the third fund under it, and we could endlessly put funds under that umbrella strategy. We are actually an investment advisor. We are an advisory firm, so we do not own those assets. So if I say we have 50 millions, this is not on our bank account, and we can just invest it as we want. But actually, we have a fund administrator. This is in Liechtenstein. This is VP Bank, and they check if the investments that we do is actually fitting with the strategy that we pitch to our LPs. So we cannot go and fundraise for venture capital and then deploy in real estate in Asia, for example. That doesn't work. So they are like the gatekeepers, and also making sure that. And I think it's a very traditional. So all the VC funds
we're a limited partnership in Ireland, but the same structure. We're the advisor, and we have a board.
Yeah, right. And especially like for institutional investors, it's a check on the box. Like they want to have. That you have that money in a Sondervermögen. So if we wouldn't exist tomorrow because we are not entrepreneurial enough or running our firm well, this has no consequences for the fund. So this is the structure that VP Bank, they check if we do the investments the right way. They also have like a legal due diligence that they make on the investment, financial due diligence. And then we have an NAV that they calculate, so the price of the fund, because we are charging fees based on the NAV. So it's very important that this NAV is calculated from an independent administration, and then also audited. In our case, this is Grant Thornton.
And so that maybe the difference there is that, So we've got the GP, so the general partner is formerly in Ireland. We have a board. They will simply review. They don't do any due diligence. And we can also fire them.
They're on your payroll. Yeah.
But no, they check to make sure that it's compliant with the with the agreements. That's all they do. And we charge management fees based on committed capital. So they don't get involved. You know, the auditor and stuff, you know, checks our valuations and stuff. Obviously, the board has to sign off on it, but they don't get involved in that, right?
And maybe, for those of you that don't know how this works, you know, this drives also the fee structure that VCs will ask from their LPs, right? And you have to be kind of cost efficient as well.
Yeah, well, we charge different we charge 2.5% management fee.
Okay.
So it's so standard in the industry is 2%, but because we work with corporates and because they really suck up a huge amount of our time, and we have a very large team. So we've got a team of 60 people.
Yeah.
All right. We review 2,000 business plans a year. We do write-ups even on the 1,985 that we don't invest in. We do 2-page write-ups. The team then has monthly calls with each corporate, because you have to understand what they want is access to innovation. So they kind of don't care what we think is a good financial investment. Right? Our portfolio is a little bit secondary to what they're really looking for. It's almost like they want open innovation services and, we happen to be doing venture capital on the side, right?
Yeah. So that's your value proposition.
Exactly, that's our value proposition. And because it is really labor intensive, they also accept the fact that they pay an additional 0.5% on committed capital.
Okay.
But they do not have a financial interest when investing with you.
That's not their primary interest. Okay. Obviously, if we were not to do a good job, I'm sure that we would hear about their financial interest, right? But we need to continue to exist. So we have to be really good financial investors in order to survive as a firm. But that's not their primary interest. And typically, you know, at our semi-annual investor forums, we get up, and when we get to the part to talk about the returns, you can see they're all looking at their phone, doing something else and stuff, and they're just not interested. But, you know, if one of our sector specialists like Alex gets up and they present some really cool technology they just heard about, they're all like, you know, this is fantastic, right? So they're less interested in the financial people and more interested in the technical.
That's interesting to know. Yeah, because I think that's their value proposition. There you go. Okay.
There you go.
Well, maybe also you kind of built onto my follow-on question. You know, you're leading a team of 60 people. And you had to build this up. So talk us through like going from zero to hero. You know, how and what is your day-to-day role? What is Gina doing today? What did you do? 25 years ago. I mean, this has also been a big personal leadership development on your side.
So I worked at a company of 45,000 engineers and very few finance people. So I thought, hey, this is a great model, right? I won't be able to understand. I have a finance background. I won't understand these technologies. Yeah. And we invest in really technology-heavy companies. And so at the very beginning, we said, team will be about 2/3 engineers, people with PhDs, X years of experience in the industry, so they really understand the market opportunity, the pain points, the value proposition of what they're looking at, and then 1/3 will be finance specialists. So in our team, and it still is that way today, people join the team actually as a sector specialist or as a finance specialist, and then they get more and more VC experience, and then they can become investment directors if they want to become partners one day, and not everybody wants to or should be a partner. Some people are just really, really great at doing their job. We shouldn't make them feel like they have to, being a partner is a different role. So then they kind of grow up. So we have, really, really high retention within the team and the investment team. Well, first of all, the executive committee, we've been working together for 24 years. And a lot of the guys who are the other partners, we've been working together from 15 to 20 years. And, we've got an average service of 12 years within the investment team. So it's really, really, it's like Hotel California. You can check in, but you can't check out, right?
But congratulations to that as well, that you built that culture.
I want people who are going to come and stay forever. It scares people when I say that, but it's true. But I think that's really important. So, now actually having 60 people and some, really, really good people in the team who've got a lot of investment experience, it's important that we also step back a little bit and let them run, right? Let them be on the boards. So I spend most of my time coaching or just being a sparring partner. I review every term sheet that we issue. I help the people who are having challenging times on boards. I help them to structure deals. I help them with anything that they need me to help them with.
Yeah.
So I do that, and I also spend a lot of time, obviously, representing the firm, like today.
Thank you.
And then also meeting with investors. I don't spend that much time anymore fundraising. Actually, I'm surprised some people will give us like 10 million without ever having met me. I'm like,
Andrea, you'll get there.
well, all right. But actually, they're not interested in people like me.
Yeah.
They're more interested in the technical people in the team anyway, right?
So Alex has to go.
Exactly. So I spend a lot of my time just on helping other people in the team become successful and hopefully not make the same mistakes I made. Make new mistakes.
That's great. And also, Andrea, how is it now for you? Because you're going basically from starting with 3, if I'm correct, but now you have a few more.
Team members?
Yeah.
We are around 10 people.
Yeah.
Exactly. And we have 2 investment managers who are at the front, and they're looking at the investments that we do.
Yeah.
One of them was the right hand from the CFO from Implenia, so he has like a very structural thinking. And the other one has scaled Frontify as the head of sales from 0 to 100 million in revenues. And this is like the great combination that we are looking for in the investment team, that we have people who actually understand also the startup side, and not we don't want to have like investment managers, typical ones, because there's no discounted cash flow calculations that you can do on a startup when we invest. You do need analytical skills, but we also put a lot of values in the industry experts that give us their feedback, and then we work with ETH for the technical due diligence. We have, of course, also partners like lawyer partners who are helping us with the legal due diligence, so we do not have to do everything ourselves. I think 100 million is good for us to manage with the 10 people, and then if we get bigger and have more portfolio companies, of course we also need more people.
Yeah. So, and also, I think this is just interesting for you also to ask questions. I didn't mention it at the beginning, but I'm going to open the Q&A now. So does anybody already have questions? You can ponder. Okay. Michael? It's on? Okay. Super.
Michael Hengartner, Chairman of the Board of the ETH domain. What could Switzerland do to become the Luxembourg of VC funds worldwide? What could we do to get more VC funds to start up here or to move their European quarters here, and so that there's all this ecosystem excitement, so that you would bring companies here rather than our companies going to the US because they need to grow with US VC firms and so forth. Where are the pain points?
Well, I would first make a distinction. Luxembourg actually doesn't have very many VCs there. They've got administrators. So we don't want to become Luxembourg.
Luxembourg for funds.
Yeah, exactly.
Right, so we want to be Switzerland for VCs, what Luxembourg
for VCs.
is
Got
for
it,
funds.
Got it. So I think, it's Switzerland, and this will be controversial what I'm going to say, so sorry for the people who don't agree. Switzerland is fantastic at research, right? But I don't think Switzerland is yet fantastic at building experienced management teams that are going to be successful as successful as they could be, as quickly as they could be in my sector, right? So in industrial tech, it's B2B. This isn't like Facebook for 15-year-olds, right? You can't just access them through your smartphone, right? This, you're selling solid oxide fuel cells to people. It could kill people, right? And I'm surprised at how many really young founder teams in Switzerland have the unbelievable self-confidence that they understand exactly how this sector works that they've never invested in or worked in, and that they're going to get it, right? Like for example, I'll give, if you're a water company and you're doing water treatment, right? And you want to sell into utilities. If you come from the industry, you know exactly that PUB in Singapore is the perfect first customer. They love to try stuff. They love to work with startups and stuff. But if you don't know that, if you don't come from the industry, you're going to try to sell to all of these utilities who will waste your time. You just end up burning a lot more cash, a lot more time passes. And so I think that if we could get those really innovative young founders together with people from the industry and get those people in the industry to also believe that this is a cool job to work in a startup, right? So they also have to be willing to leave their comfortable job at Siemens or ABB or wherever and join that founder team. I think we will have more successes here. And I think successes will basically attract the other VCs, right? I don't think that also to bring the startups here, right? I think that wouldn't be a problem if we felt that there was experienced talent willing to join startups and startups who understand how to attract these people. You have to give them a cut of your cap table. You have to give them ESOP. I realize you're wonderful and you're the founder and you're the one who invented this, but it's not going to sell on its own, right? So I think there's a certain lack of appreciation for industry experience in the starter community in Switzerland. Sorry.
So the politics, they wanted to make it that more VC funds are coming to Switzerland with the LQIF, which is the fund structure which we have in Liechtenstein, which they wanted to bring to Switzerland. But the problem there is no one wants to be the first one. Also with the funds that I'm talking to, they all say, I don't want to be the first one. It would be great to have the fund actually here in Switzerland. We all agree. But there is also a lack of experience. So one example is we are very creative because we are very young and we need to be flexible. And when we have investors that come, then they ask for certain things. We are always trying to figure out ways. And one example is that many investors, they come to us and they say, my money is stuck up for 10 years, right? So I have no liquidity. What can you do? And we said, okay, maybe we could have two clauses for the fund. One is free, and with the free one, you need to make commitments to buy fund shares of people who pay 5% or 4% for the fund. And the one that pay 4%, they have liquidity. So that's an example. And then we went to the VLP Bank, which is very experienced because they have many different kinds of VC funds. And they were like, do not do that. We have tried this kinds of things. That has never worked. So this is like the kind of experience that we as an emerging VC, we also want to have from the fund administrator, which a Swiss fund administrator would not have yet. But I think die Weichen sind gestellt with the LQIF. It's possible that you can have your fund here in Switzerland.
Thank you. Yes, please.
Thank you very much for sharing the insights. My name is Bastian Wiedmer. I'm a professor for business and management, and I was previously leading the M&A and venturing department of a company. And we made smart money investments. And of course, these smart money investments were along with cooperation agreements and with legal issues of non-compete clauses, etc. So my first question is, and how do you deal in the funds with previous smart money investments? Is that a no-go where you have a certain exclusivity for a certain industry? And how do you deal with that along the way when smart money investors wants to join? The first question. The second question is, like, if you have corporate investors in your funds, they want to collaborate, so they want to generate value out of this cooperation. How is that taking place? How is the value generation for the corporates actually on an operative level really taking place? Thank you.
Yeah, sure. So obviously, because we've got the 60 corporates and we are in constant dialogue with them, trying to understand what it is. So let's say they might have, want to reduce their environmental footprint, right? So they need a certain technology that's going to help them to do what they're doing more efficiently. Water, could be energy, could be sustainable materials, right? So they see actually what deals we're looking at. They can see that we have a platform, and we actually ask each entrepreneur if we can make the deck available to our LPs. And about 70% say yes. And so then the corporate can get to understand a little bit better. So what does the solution do? And then on our monthly calls, then they'll ask us, hey, could you put me in touch with this company, right? And then we'll facilitate that. I mean, sometimes you can lead a horse to water, but you can't make it drink. And so we sit there and we try to, really help them to drink. So we have workshops around certain topics. Like we just had this week, I think it was the data center topic, where we brought in a bunch of corporates, a bunch of startups, not even our portfolio companies, and try to coach them through a several-week program to see if they can come to pilots, right? What's really important, it is completely up to the startup whether they want to enter into this relationship. We do not make our investment dependent on any collaboration with any of those LPs. That being said, in our sector, corporates are more and more active investing in these companies, and sometimes it actually is really helpful for the startup even to have these nice logos on their cap table, on their website and whatnot, and it brings a certain credibility to them. I always tell them, don't count on the collaboration actually working, because sometimes even though the corporate has really good intentions, nothing's really going to come out of it. So make sure you really like their logo on your cap table. And then we have to deal with certain areas of conflict of interest, right? So the corporate, we have it already in our term sheet that it's the company's and the board's decision to exclude the corporate from certain information that we think is commercially sensitive, right? The corporation might say, we're making our investment dependent upon exclusivity in a certain area, which can sometimes boomerang, right? Because if the startup says yes, we go, well, then we're not investing, right? I mean, because you've basically just given away, basically kind of a lot of rights to somebody who we thought was going to potentially be an acquirer, and now they have no incentive to acquire the company, right? So I think it is a balance, but it's worth it. It's, I think this relationship, corporates can help startups to accelerate the commercialization so much that I think it's in all of our best interest to figure out how those relationships should work and kind of what rules of the game like we need. What are best practices? How are we going to do this? What is a conflict? What isn't? When should a particular board member or board observer recuse themselves from the discussion, right? Mm-hmm. So I think it's a lot better today than it was even 10 years ago.
Mm-hmm. I have time for one more question. You want to? Is that true? Yes, or maybe two, depending how fast they answer.
I'll go fast.
I'll speak fast. So thanks a lot, great discussion. My name is Enzo, I'm Chief Commercial Officer of Anybotics. I'd be curious, we have more and more scale-ups in Switzerland that are about to tap or needing to tap into much larger sums for next financing rounds than we had probably 10 years ago. And there's a challenge to get that capital within Switzerland. So what naturally happens is you go outside of Switzerland to get that. It's less a challenge to get the capital if you have the right business, but it's not staying here. And I wonder from starting a VC fund, what does it need to have more of those, larger, later stage VC funds actually being able to invest in Switzerland? Which, one way could be that you have more funds coming here, but also from starting new funds, it probably takes certain credibility to get to that level. But how can that be sped up in a way to untap or tap into new types of capital to accelerate that?
Yeah. It's a very, very long-term business. It takes a lot of time. So for the first fund, from the first deployment until you exit, it takes 10 years. So we've been around since 2018, and we are still a very young and emerging fund, right? So the answer is you need a track record. You need trust from investors so that they invest more money into you. And that takes time. And then the more money you get, the more assets that you have under management, the bigger tickets you can make, because you cannot be a later stage investor that makes 1 million investment, right? With Anybotics, you wouldn't have taken your Series B, for example, you wouldn't have taken that investor. So you need a certain size, right? So track record, bigger funds. Now, if pension funds would invest more in venture capital, I think this is like one of the obvious answers, because they have 1,000 billions asset under management just alone in Switzerland. And if they would invest only 1%, which would already be a lot, into venture capital funds, they could do better tickets. We wouldn't be so dependent on foreign investors. And today it is. We have over 80% that is invested in Swiss companies is coming from abroad, and this is just because of the later stage funding round. So there is a huge gap there.
And maybe because I had the idea for this session, just to give you some hope, the idea of mine was we need more ballsy fund managers that go out and say, 100 million is small, and just go, that are, if you think about this asset class, we're also all entrepreneurs that are standing here, because we were crazy enough to have a crazy fund idea, and we went out there and raised, right? Despite, also for me, despite having this track record, right? We kind of knew a bit, like you were saying, you not even Googled what this asset class is doing. And I sometimes feel like we should ask for more. So sometimes we even suffer the same Swissness, that we target quite low fund sizes. But it also, I never forget this was just recently, but I met a lady that was fundraising for a US fund, and she was like on the Lego family, she was like really getting them. I asked her fund size, and she's also said like 750 million. Yeah, 750 million. She was about the same age, and I'm like, man, I have to go more to the US. I'm half American, but I would never go out there and raise this fund size. So this could help speed it up, and this was also the idea for the session.
But it's also the fund strategy, right? So we, even though we have 750, we still invest in early commercialization. So our first ticket is 4 to 5 million, right? It's not going to be 20 million tomorrow. We might say, hey, let's also raise a growth stage fund, which much bigger tickets. They have to be much bigger funds, and that's when we need the institutional investors basically to buy into that strategy. Right now in climate tech, at least, there aren't a lot of big institutional investors that want to deploy big checks into this sector. And if there were, then we would have people coming out, and like we could easily then I say, we could theoretically raise a growth fund, right? That could then write, if somebody comes to us today and says, hey, we're raising 100 million, we pass, because that's just, it's not we don't see ourselves in that round. But if we had a growth stage fund, we'd say, yeah, sure, we'll lead, right?
Absolutely. I hope this was interesting for all of you. I'm going to close out the session. I could talk forever with you two about this, and I also enjoyed the room. So thank you, Gina and Andrea.
Thank you very much.
So for those of you that still had questions, maybe they'll take them individually.